Well, I will also touch upon the attempt to increase portfolio efficiency. We've heard a lot about that this morning. I will pretty much talk about the same underlying concept and show you how this can be implemented in the form of indexing and what risk and return characteristics those indices would have. My understanding of an increase in efficiency is an increase in return we can generate per unit of risk that we take. And I believe this is more important than ever given the current market environment. We see a steady decrease in bond yields, so the presumably less risky asset class became less and less attractive over the course of the last years. Unfortunately, at the same time, we find that the opportunity in investment in the more risky equity asset class became more risky, much more risky. As a consequence, future expected returns are currently more uncertain than ever. In fact, if we look at the developed European equity market, we now face volatility levels of somewhere between 20 and 25%, whereas 2 years ago, those levels ranged somewhere around 10 to 15%. So a huge increase in volatility, a huge increase in uncertainty. What to do? I would like to discuss two approaches. The first approach ties into what we've heard earlier today, the move away from standard market cap weighted indices into the smart beta space. And I know that there are probably as many definitions of smart beta as people around that talk about it. So my definition here is the attempt to get a systematic exposure to well-defined sources of risk, value, momentum, for example, hoping for an adequate reward in the form of a risk premium. So the first approach would be to add additional sources of risk to an existing index in order to increase the efficiency in the form of returns we can generate per unit of risk taken. The second attempt is to focus on an existing set of factors. I will show you an example based on the country factor and make that factor work harder for us, increase the factor exploitation, increase the efficiency of just standard factors. And we can find that, or we will find that this also leads to a significant increase in risk and return characteristics of entire portfolios. Here you see a more graphical representation of those two. I call them evolutions of indexing. The first focuses on a move away from standard market cap weighted indices into the single and, as we've seen over the last few years, even into the multi-factor space. The second approach or attempt focuses on an existing set of factors and the attempt to increase factor exploitations to make factors more efficient, to redefine existing factors. Let us start with the first approach. We've heard that market cap weighting may not be the smartest thing to do. In fact, over the last years, we have read papers where it was found that even monkeys randomly selecting and weighting stocks seem to do a better job in capturing returns than market cap weighted indices do. And the question now is, if that's the case, how bad is it? And we see here for the case of the developed European equity market, the performance on a per annum basis for various different weighting mechanisms. So always the same underlying universe of stocks, just the application of different weighting and selection mechanisms. We find that a standard market cap weighted index, the STOXX Europe 600, for example, would have generated an annual performance of 6%. Not bad, but we could have done a lot better by just equal weighting all the stocks. Same composition, just applying different weights, would have added another 2 percentage points measured over the last 12 years here. Applying a single factor concept such as minimum variance would have added another 2 percentage points to overall performance, and the multi-factor approach that systematically captures premia from various different sources of risk would have more than doubled returns from 6% to, as we see here, 14% over the course of the last 12 years on a per annum basis. What I tried to indicate here by the width of those bars are the assets under management tied to those strategies. We find that The vast majority of assets here in the form, or here linked to ETFs, are still tied to standard market cap weighted index concepts. Only for the case of those 3 selected weighting strategies here, 1% is about invested into those alternative weighting mechanisms. So on average, the vast majority of investors lost on a relative basis, lost out on performance, sacrificed performance by sticking to those traditional market cap weighted indices. The question now arises, why are market cap weighted indices so bad? Or to put it differently, why do all those alternatives outperform? We have heard a lot about it this morning. One of the major reasons for it is the absence of a systematic exposure to predefined sources of risk. We find that we can in fact break down the performance differential between factor indices and market cap weighted indices into quite a few well-known sources of risk, such as carry, low risk, momentum, quality, size, and value. And as you see here on the left-hand side, all those sources of risk have been, over the course of the last 12 years, in the long run, systematically rewarded in the form of risk premia. So one observation here is that the exposure to those sources of risk was rewarded, is a source for additional return. And I should mention all those returns here are beta neutral, market neutral, so are excess returns over the STOXX Europe 600, constructed via a long-only portfolio. And then for the sake of this analysis, I just shorted the market by going short the STOXX Europe 600. Additional source of return is one very important characteristic. But what we see is, this is displayed here, the correlations. This is very interesting. The correlations of those factor returns to the markets, to the STOXX Europe 600, are on average even negative. And we all know negative correlations are a good thing when it comes to diversification, reducing risk. And in fact, we see when we combine factor exposures, single factor exposures, with the broad market, the STOXX Europe 600, for example, the combination shows even lower levels of volatility as compared to the STOXX Europe 600 as just a single investment. So adding another source of risk doesn't mean adding overall volatility, increasing the level of risk. It even, as we see here for the case of the European market, tends to reduce risk. However, what is very important to mention in this context is that risk factors, and this is something we have touched upon earlier this morning, risk factors aren't always rewarded. There are times where risk factors or the exposure to factors has actually been accompanied by negative returns. Investors would have been punished by being exposed to those sources of risk. Here we see, for the case of size and value, for example, huge negative performances in the year 2007, leading up to the European debt crisis, or to the financial crisis, or in the year 2011 during the European debt crisis. This observation, the fluctuation of returns over time and very low correlations among those factor returns that you see on the right-hand side, they move somewhere a range between 0 and 0.6 for those long-only market-neutral constructed factors. Those two observations, fluctuation and low correlations, provide the ground or the rationale for multi-factor investing. So why should I invest a huge portion of my funds into just a single factor exposure if I can diversify across various different factors? However, when it comes to combining factors, it is very important to understand what happens if we combine factors in different ways. In fact, I have displayed two extremes here on the right-hand side of how we could go about combining factors. One extreme would be an index of indices approach. We just construct single factor indices and then somehow equal weight all those single factor indices or weight them by the inverse of volatility, whatever. It would lead to the inclusion of companies that are very highly exposed to just one factor, but may at the same time have a very low exposure to all the other factors. In this two-factor case or scenario, we would select companies from all of those quadrants here. The other extreme would be to focus only on those companies that load very highly on all the factors to which we seek exposure. The other extreme here, we would attempt to select companies that fall into this quadrant here, quadrant B. The approach we choose when it comes to building multi-factor indices is very important for risk and return characteristics. As we see here on the right-hand side, I plotted the performance for a single equally weighted average of factor indices, which would have yielded over the course of the last 12 years a total return of about 40%, 38%, whereas the attempt to focus more on those stocks that fall in this intersection, that load very heavily on more than one risk factor, would have yielded a performance of 110% over the same time period. So the stocks we select, we focus on when it comes to building multi-factor indices matters greatly, as we see here in this case with regards to performance. So up to here, we have seen that adding additional sources of risk to an existing portfolio, to the STOXX Europe 600, for example, is a great source not only for additional return, but as we've seen, due to the low correlations, also for diversification purposes, to reduce the risk of the overall portfolio. Now I want to focus on the second topic, the second route that I initially mentioned, the focus on just a very standard factor, in this case the country factor, and the attempt to redefine the country factor to make the country factor more efficient in order to then increase portfolio efficiency. I would like to use a set of indices that we launched last year that we call STOXX True Exposure Indices to demonstrate that effect. STOXX True Exposure Indices are designed to serve as a better, as a more distilled, more focused regional benchmark compared to standard traditional benchmarks that select companies just based upon their country of incorporation. We look at the same time at the regional source of those companies' revenue generation. We make sure for the construction of a true UK index, for example, that companies that are selected into that index are not only headquartered or domiciled in the UK, but also generate a significant portion of their revenues in the UK. We find that by doing that, by taking into account that additional piece of information, we're able to deliver on two value propositions. The first is that our indices capture local market characteristics to a much better extent by being more focused on the targeted market, on a targeted market. At the same time, those indices are more immune towards external shocks, towards things that happen, macroeconomic events that happen outside of the respective targeted market as compared to standard traditional regional benchmarks. The second value proposition, and I will show you an example later, focuses on the combination of STOXX True indices, of various different disjunct indices in a portfolio context. When we combine those indices, we find that the overall portfolio is much more efficient as compared to a combination of just standard regional benchmarks. Let me start with an example here for the case of the United States. Let's assume we have a European domiciled investor who would like to extend or to diversify regionally into the US equity market. If he added the US portion via an investment into the S&P 500, he would get a true exposure to the United States only worth about 65%. Why is that? Because US companies selected into the S&P 500 generate only about 65% of their revenues in the United States. The remainder is generated outside of the United States. We see more than or almost 10% in this case comes from emerging markets. So every pound invested into the S&P 500 would generate only about 64 pence worth of true US exposure. If we now move along from left to right here and would, for example, include only those companies that generate at least 50% of their revenues in the United States, we find that effective exposures increased dramatically to about 80%. So we added about 15 percentage points in effective exposure. If I relate that to what we've heard earlier today, where we talked about the factor efficiency ratio, this would be somewhat comparable to factor efficiency ratio. A standard S&P 500 index would have an efficiency of only 65% when it comes to gaining exposure to the United States. The truth 50%, for example, would have a much higher efficiency, a much higher factor exploitation of about 80% here. We could move all the way up to 100% and then have a true exposure to the United States, including only those companies that generate all of the revenues locally. Now this doesn't only affect the characteristics, risk and return characteristics of single indices, single country indices, it also affects the characteristics of entire portfolios. If we span, as we've done here in this example, the world by 3 different regions, the United States, developed markets outside of the United States, and emerging markets, and plot the respective regional source of revenue allocation. Here we find that, as just mentioned, US companies generate only about 65% of the revenues within the United States. 22.7% of the revenues are on average generated in developed markets outside of the United States. Now, companies selected into developed markets outside of the United States generate in turn about 16% of their revenues in the United States. So those traditional regional benchmarks have huge revenue overlaps among each other, which causes those benchmarks to be, I would say, unnecessarily highly correlated. The revenue overlaps increase the homogeneity, increase correlations, and high correlations are always bad when it comes to diversification to increase portfolio efficiency. If we would replicate the same portfolio in the extreme here by indices that include only companies that generate all of the revenues in the respective targeted market, we would find that the portfolio would be much more efficient. We could construct combinations that yield significantly higher returns per unit of risk taken as compared to the combination of traditional benchmarks, or to put it differently, we can move the efficient frontier further over to the left. So to summarize at this point, we have seen that there are 2 ways among, I would say, a lot more, but 2 very promising routes, promising approaches that we can take in order to increase the efficiency of portfolios. The first is the addition of systematic factor exposures to an existing portfolio, seeking some type of compensation in the form of risk premia. We've seen that this doesn't only increase returns, it also tends to reduce risk. The second attempt would be to focus just on a standard set of factors on a given portfolio and investing more time, more work to increase the efficiency of existing factors. Both lead to higher returns and lower risk, or increase the efficiency of the overall portfolios. Thank you very much.